If you've been watching the news at all, you've heard about the banking crisis going on right now.
With a garden variety corporation, a poorly managed company, that's a problem for the shareholders, maybe for the employees. But with a bank, it has larger consequences.
I mean, we have these financial crises periodically, and in retrospect, it's obvious we didn't see it coming. Why is that?
Well, it's partly because when the going is good, and the going's been very good in recent years, given all the easy money conditions, when the going is good, people don't necessarily look for risks.
And really, at the end of the day, that's not why these banks failed. These banks failed because there was a run on the banks.
The markets have been up and down. Financial stocks in particular are getting hammered as people are worried that their money isn't safe at their local bank.
This banking crisis, or whatever you want to call it, is it done? Is it near the end? Where are we?
You know, the fear of a whole bunch of banks failing in the United States is not valid at this moment. What you really have to fear is where are we going from here?
And banking stocks in particular are getting crushed. But even with all the uncertainty going on right now, there's two particular financial stocks that I'm watching, and I'll tell you why. Number one, JP Morgan. So JP Morgan, the biggest of the big banks, every Bitcoiner's enemy number one is their CEO and Jamie Dimon. I'm only partially kidding, but here's why I like JPM right now. So number one, their free cash flow yield is very good. Their cash flow yield based on average enterprise value is 8.38%, and cash flow yield to market cap is 9.38%. Free cash flow yield is something that I like to use whenever I evaluate stocks, mainly because companies can use accounting tricks to kind of work their earnings to where it looks better than it really is, whereas free cash flow really helps you understand how much cash is the business generating, and regardless of what kind of time it is, whether it's recessionary times or boom times, businesses that generate cash are always going to do well. In terms of price, JP Morgan's come down a little bit due to the crisis, so it's at more attractive levels. Morningstar has JPM rated as 4 stars in terms of value for price. JPM has a pretty decent dividend yield at 3.15%, and it's very stable with a 31% payout ratio. They've also grown the dividend pretty well with a 13.54% annual dividend growth rate over the past 5 years and 12.79% over the past 10. And the other two reasons that I like JPM right now is one, it's probably going to end up being a likely landing spot for any of these banks that need to be acquired. Now, that's a double-edged sword. It could be a good acquisition, it could be a bad one. But in general, JPM ends up being that big bank that people get swallowed up into, regardless of what you feel about that. And so there may be some opportunities for JPM that normally wouldn't be there just because of what's going on right now. And then the second thing is, for as much as I joke about Jamie Dimon, I actually think when it comes to being a bank CEO and running a bank, he's probably the best in the business. So that's definitely a plus for them. In terms of the JPM stock, I do have a little bit of my portfolio already, but I'll be looking to buy if it continues to dip, especially anything under 120. I'm probably definitely going to be buying. But now, obviously, buying a bank stock during a banking crisis is risky. So do your own research, make sure you're comfortable with whatever you're thinking. And for me, I think JPM is high quality. If it dips below 120, I'm probably buying. Number two, American Express. American Express, I talk about these guys quite a bit because I use their products every day and I love them, and I think they're a really well-run company. So here's the things about American Express that I like right now. So free cash flow yield for American Express is also very good. The cash flow yield based on average enterprise value is 9.04%, and the cash flow yield to market cap is 10.28%. Now, Amex doesn't have a huge dividend, paying only 1.47% yield, but they have a strong payout ratio at 21%, so it's stable, and have shown good dividend growth of 9.19% over the past 5 years and 10.03% over the past 10. And then lastly, I already mentioned, I'm a huge fan of American Express and their products, so just as a customer, it's a company that I really like. Even with all the craziness going on, Amex isn't actually trading at that much of a discount. Morningstar has them at a 3-star price right now, and they haven't gone down as much as other financial stocks have, but they're down a bit from their most recent peak. So Amex is one that I'm not buying right now because the price really hasn't come down enough to where I want to jump in, but I'm going to watch it and see what kind of decisions the Fed and our government officials make to see if it has the prices come down a little bit more. And if Amex dips to a more attractive price level, I'm definitely going to buy because it's one of those stocks where I'm constantly watching it to see when the prices dip to be able to add more. And remember, at the end of the day, investing always comes with risks. So while it might seem weird to be looking at financial stocks during a banking crisis, some of the best buying opportunities happen whenever the market panics. You just have to do your own research and understand what you think something is worth and why you're buying it. Are you guys watching any other financial stocks? If you are, put them down in the comments below. And if you're looking to build your own dividend portfolio, check out this video right here where I talk about my 5 buy and hold forever dividend stocks. Hope you guys have a great day out there. Life's too short to not have the means to enjoy it, so keep stacking those wins, and I'll see you guys on the next one. Peace.